This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When dealing with losses that arise on cessation of trading, it is incredibly important to ensure that you answer the right question. An obvious statement, I know. But when dealing with cessation, there are two different styles of question that may be posed. What you see on the notes in front of you here is a very specific and individual issue. And that is the computation of one particular loss, a very specialised loss, as we mentioned at the end of our previous lecture together, that deals with losses that arise specifically on the cessation of trading, and even more specifically, within the last 12 months of trading. Now, if a question simply asks you to compute the terminal loss relief, then it is this exercise here that you perform. However, a situation might be rather more detailed than that. It may ask you to advise on the loss reliefs that may be available on cessation of trading, and also to deal with the assessments that arise within those final tax years. So be very careful to interpret the precise question. If you've got a Section A objective testing question, it may be very much what, again, you see in front of you. Purely from the numbers provided, compute the amount of terminal loss relief that is available to the taxpayer. But if you're dealing with a Section C question, it might be a cessation of trading scenario, where one of the loss reliefs that arises is, of course, this one, the very specific terminal loss relief, but there are also other reliefs. Don't worry, you are perfectly well aware of those other reliefs that are available to the taxpayer, that need to, in addition, be identified, but also, of course, because it won't just be losses, to work out what assessments arise over the closing years as well, i.e. dealing with the normal cessation of the unincorporated trader, as we dealt with in the previous chapter, chapter 6 there, but with the added ingredient of a loss arising probably within that final period of trading. So, when we look at a problem of this nature, the cessation of trading, what are all of the exercises that we might be asked to undertake, rather than just the very specific individual calculation of a terminal loss relief? Well, as we've said, what you may have to do is to determine the assessments in the closing years. Now, for that, you need to know what the bases of assessment are. Again, if you can't remember them, then go back and look at your notes on chapter 6 and rework through the exercises to make sure that you've understood the bases of assessment that apply. I hope, however, you recall, if I quickly now recap for you, that it is essentially a simple three-step technique that we adopt. Step 1, look at the cessation date. And that cessation date will then determine the final tax year. So step 1, you identify what tax year is the final tax year based on the cessation of trading date. Step 2, having determined what is the final tax year, you go back to what then must be the penultimate tax year, the one before the final tax year, and you assess it and any years prior to that using CYB, your normal current year basis of assessment. Step 3, the final step here, having established what has been assessed in the penultimate tax year, then any remaining periods, be they of profit, be they of loss, be they both of profit and loss, there may be one, there may be two periods that now are as yet unaccounted for. You will allocate any remaining periods post the assessment period for the penultimate tax year. So anything that is left after the penultimate tax year's CYB assessment is going to be one or two periods at most. Those are allocated to the final tax year. Now, back in chapter 6, that result gave you a profit figure that was then reduced by any overlap relief that arose from the overlap profits that you identified in the opening years of that then new unincorporated trade. What may now happen, of course, is that we end up with a loss within that final tax year of assessment, and of course what will an overlap relief therefore do to a loss? It will make it bigger. So rather than the overlap profit reducing what was a profit figure, it will instead increase a loss figure. Determine assessments therefore in closing years and compute losses available for relief. Now then, you've already done half of this already, because if you have a loss for that final tax year based on whatever fell within the basis period, inclusive then of any overlap relief, if you have such a loss, then what can you do with it? Well, what normal loss reliefs do we already know? You know about the simple carry forward relief. Well, clearly that's not an option now, is it? The business has ceased to trade. There is nothing to carry it forward to. So we can strike that one off the list. But of course, what about the usual routine one of setting off a loss of the tax year against total income of that tax year and or the preceding tax year? So that current year relief and or preceding year relief against total income is as available now as it ever was. The fact that this happens to be the cessation of the trade makes no difference. It is still available to the taxpayer. And if, of course, you make a claim against total income, be that in the current tax year or be it in the preceding tax year, then having done so, and if loss still remains, there's still some additional loss available to you, then of course you also have that extension claim, the ability to change the nature of the loss from trading to capital and put it against any chargeable gains that may arise. And that for the final tax year might be a realistic possibility, because if you are dealing with a cessation of trading, albeit in a loss-making situation, there may still be assets of the business that the individual is able to sell that generate chargeable gains. So there may very well be chargeable gains arising in what is the final tax year of trading. So before we enter into the new element here of terminal loss relief, make sure that 1, you understand the bases of assessment in closing years. We're going to practice those in a moment's time. You also realise and understand how to apply your normal loss reliefs against total income of the current tax year and or preceding tax year. And if such a claim has been made for a tax year, be it the current or be it the preceding tax year, then having done so and there still being loss left over, then that of course can be then picked up in your extension claim against chargeable gains. Now, over and above that, and with a totally separate calculation of it, there is the new component, the terminal loss relief. So, what do we have to do in answer to an exam question? Well, firstly, identify what is the question asking you to do. If it is only, like a Section A question, compute the terminal loss relief available, then what I'm about to do with you in a moment, revising through what we already know about assessments in closing years and the normal loss reliefs that we've seen up until now, then none of that would be relevant. You just go straight in and do the yet-to-be-seen new terminal loss computation. But if a question asks you, as a Section C question may do, to deal with the overall issue of the cessation of trading, then you would have to identify, if there are losses, what are the various loss reliefs available, not just the specific terminal loss relief. And of course, you'd have to deal with the assessments that arose over the final tax years of trading, applying those bases of assessment in closing years. So, let's do that exercise first, i.e. the revision exercise. The first bit, determining the assessments in closing years, and as part of that process, excluding terminal loss, computing what losses might be available for relief. To help us with that, we have a little example here, by the name of Donald indeed. Well, Donald ceased trading on the 31st of May 19. We can only hope. Donald ceased trading on the 31st of May 19, having previously prepared accounts to the 31st of December in each year. Right, It's a cessation. So what do? Step 1, of course, is to identify the final tax year based on the date of cessation of trading. So what tax year does that fall in? Clearly 31st of May 19, that's in the 1920 tax year. If 1920 is the final tax year, what therefore is the penultimate tax year? So the one before 1920 is 1819. And we use the normal CYB, current year basis, in that penultimate and in all prior tax years to that. So what have we got? We've got the accounting year ends 31st of December. So in 1819 tax year, which year ended 31st of December will be assessed? Is it going to be year ended 31st of December 17? No, because that ends in the 1718 tax year. So 35,000 using CYB will be assessed in 1718. Therefore, year ended December 18, yeah, that's the one. That ends in 1819, so 12,000 will be the assessment in 1819. So what we've already done, just by reading through that information in the question, is to identify that the 1920 tax year will be the final tax year. The penultimate tax year is 1819. Using CYB will assess year ended December 18, and that will be £12,000 to be assessed. Because they've also provided the information for the previous year, again using CYB for 1718, then it's the 35,000 to be assessed. Going back to my three-step approach, step 1, identify the final tax year based on cessation of trading. Step 2, identify the assessment for the penultimate tax year using CYB. That is your £12,000, the year ended December 18. Step 3, allocate any and all remaining periods. There is only one such period in this example, the period to the 31st of May 19. Allocate that to the final tax year, 1920. This time, of course, it happens to be a loss. And what is also allocated to that final tax year? The overlap profits. What will overlap profits do? They will therefore increase, of course, the amount of loss available to us. What does the question require us to do? Compute assessments based on the above information and identify the loss reliefs available to Donald. Okay, putting that into practice, therefore, step 1, 1920 was identified as the final tax year. Step 2, go back to penultimate tax year, that must be 1819, and assess using CYB. That, therefore, was the year ended 31st of December 18, and that was a profit, as we see there, of £12,000. Given that they want us to cover all tax years, as far as the information provided will allow, we also know that for 1718 we'd have used CYB, and that would have been the accounting year ended 31st of December 17, and that was £35,000 of profit. So there we go. We've dealt with step 1, step 2, step 3, the final tax year, 1920, allocate any and all remaining periods to that final tax year. Well, where have we got to in 1819? We've got to 31st of December 18. So there is only one further period to be allocated to that final tax year. All other periods are accounted for in the earlier tax years of assessment. That is the period to the 31st of May 19, and that, of course, was a loss of £30,000. We also allocate our overlap profits, or overlap relief you can call it now, which is £10,000, giving us overall therefore a loss of £40,000, which, as when we were dealing with our opening years and before that normal rules of loss reliefs and assessments, if we have a loss within the basis period, then that is a nil assessment. So we've now identified the assessments for the final tax years, they being in 1718 £35,000, in 1819 £12,000, and a nil assessment in 1920. What lies behind that nil assessment? A loss of £40,000. So what therefore are the various loss reliefs available? Now we know that there is no carry forward. So what can we do? We can set off against, what's the normal relief? Set off against total income of 1, the current tax year. What is the current tax year? That final tax year equals the 1920 tax year. And or the preceding tax year, and that of course equals 1819. What we may also do, plus extension claim against chargeable gains, but of course only following a claim, against, well, as we've just seen, total income of that tax year, the one for which we're making this extension claim. Now, all of that is, in point of fact, basic revision of things that we've done before. The bases of assessment and the establishment of those assessments in closing years, that was Chapter 6. The loss reliefs in terms of set off against total income of current and or preceding tax year, and the extension claim against capital gains, that's what we've done already in Chapter 7. So there's nothing new there. So we have looked at this in the whole rather than looked at one specific issue. We've identified the assessments for the closing years of the business of that trader Donald. We've also identified, so far, the loss reliefs that we're already aware of. But that £40,000 of loss that could be used in those claims against total income and thereafter extended against capital gains if we chose to, and if there were, of course, such gains to be relieved, those are supplemented by an alternative loss relief. And that loss is not computed in the same way as we've just done, i.e. by merely looking at what is a figure of loss within the basis period for the final tax year of trading. Instead, it has its own separate and individual calculation. So now let's look back at the notes that tell us how it is that we compute that very specific terminal loss relief. Now, before we do that, do please make absolutely certain that you're okay with the exercise that we've just done. You're happy with the bases of assessment in closing years, how to deal with a loss, then it's a part of the basis period for a tax year, and then the normal loss reliefs that are available. Once you're happy with that, then continue with this on terminal loss relief. Now, terminal loss relief, a very specific relief. Terminal loss, as computed, we'll see what that is in a moment, is set against the trading profit, so very specific now, trading profit, for the tax year of cessation, which, as we'll discover in a moment, is in fact very unlikely that there would be a profit for the tax year of cessation. Why? Because we're going to be making losses over this final period. It is, however, theoretically possible for a terminal loss to arise and for there still to be a profit assessable for the final tax year because of the two different ways of establishing those figures. Now, it's never been tested, and I cannot imagine that the remote circumstance in which it would arise would ever be tested. So the reality here is that, though if you get a written question, you write it out as this: we set against the trading profit of the year of cessation, and then against the trading profits of the previous 3 tax years on a LIFO basis. The reality is that we're going to go against the trading profits of the previous 3 tax years on a LIFO basis. Remember, LIFO. So the most recent year first, working backwards. The opposite to what we did with the specialist opening years relief, where with that specialist opening years relief, again we carried back 3 years. There, however, it was against total income, not as this is against trading profits. But we went against total income of the previous 3 tax years. There, in opening years, it was on a FIFO basis. We went back to the earliest year first and came forward. Now we go to the most recent year and work back over the preceding 3 tax years. It's on a LIFO basis. But it's not the £40,000 figure that we computed a moment ago in our Donald example. This has its own very separate and special calculation. The terminal loss is the loss of the final 12 months of trading. Very specifically, purely what's in the final 12 months of trading. But that final 12 months of trading will need to be divided. It's computed in 2 parts, dividing the last 12 months of trading between the final and the penultimate tax years. Now again, it is incredibly unlikely that you would cease trading on the 5th of April, the last day in the tax year. If you did, then it's very easy. Then the last 12 months of trading is exactly the last 12 months, that final tax year. It doesn't span 2 tax years. But the reality is you're going to cease trading on some other random date within a tax year. So the last 12 months will cover all of the final tax year and a part of the penultimate tax year. So with that in mind, we now need to divide this terminal loss computation into those 2 parts. The part that falls into the final tax year, that therefore is the actual trade loss for the tax year of cessation, i.e. from the 6th of April at the beginning of the tax year of cessation through to the date of cessation. What we will also add to that, plus any overlap relief arising from opening years. So our overlap profit, our overlap relief will be added to that figure. So there's the first separate part of the calculation of terminal loss. Once done, we then do the next part. We now want the actual trade loss for the period from 12 months before cessation through to until the end of that penultimate tax year. So our last 12 months of trading began 12 months prior to the date of cessation. So in this second part, we go from that date through to the end of that penultimate tax year, i.e. the 5th of April. So we're splitting the last 12 months into those 2 components. Now then, not that it would probably happen in a question at this level, but the reason for doing it that way is if the result of either what you got in part 1 or much more likely what you might get in part 2, if the overall result for that period turned out to be a profit, then that would be treated as 0 for purposes of the terminal loss computation. So it wouldn't reduce, therefore, the other part of the loss. So if this outcome here for the actual trade loss for the period 12 months before cessation until the end of the penultimate tax year, the part of the last 12 months falling in the penultimate tax year, if that gave you a profit figure overall, then that would be treated as zero, as nil, for purposes of terminal loss. So the terminal loss would be entirely what was in there, what was in the final tax year. That's what would be in the terminal loss. This bit of profit in this period would not serve to reduce the overall amount of terminal loss relief available. But again, it's an unlikely circumstance, but it does happen. It does exist in reality. So those are the rules that we need to apply. Right. Let's have a little go, therefore, at this exercise here. Okay. David has the following trading results before ceasing to trade on the 31st of May 19. 31st of May 19, that makes it, like we had a moment ago in our Donald example, the 1920 tax year is our final tax year. Now, what are they asking us to do here? Show how the loss available for relief under terminal loss relief, assuming overlap profits on commencement were 5,000, and state how this loss would then be relieved. So here we have a very specific calculation that identifies terminal loss. We want to compute that terminal loss and then show how that loss would be relieved. The computation of the terminal loss is based on these two calculations here. What can we do with that terminal loss? That is what we identified here with the carryback against the trading profits of the preceding 3 tax years. So I'd just like you to pause for a moment there, go back, look at those notes, think about those notes before together we have a go here at example 6. Okay, let's deal with example 6 therefore and put our calculations together for the terminal loss. Now, we know that our terminal loss computation needs to be divided into 2 parts, they being the final tax year and the part of the terminal loss falling into the penultimate tax year. So what is the final tax year? It is, as we've already identified, the 1920 tax year. And for that 1920 tax year, there are 2 figures that we need. What do we need? We want the actual trade loss for the tax year of cessation from the 6th of April to the date of cessation, plus any overlap relief. Okay, see what we've got there. Final tax year 1920, so we want the loss from the beginning of that tax year, the 6th of April 19, through to the date of cessation. Well, that's not very far away, the 31st of May 19. So how many months is that? April, May, 2 months. Out of how long was our period? Our period was 10 months to the 31st of May 19. Therefore, we want some 2/10 of how much was the loss? £20,000. 2/10 of £20,000, what does that equal? Well, that, of course, is going to give you £4,000. What do we then add to that? A figure, of course, that will be provided to you, our overlap profits, our overlap relief. What is our overlap relief? We're told that the overlap profits were £5,000. So there's the first part of our terminal loss, amounting to £9,000. And what that means is, no matter what we get in the second part of this, the penultimate tax year, that the lowest the terminal loss could be is £9,000. Now, don't worry, we're going to be adding to that, of course, because most of the final period of loss, the £20,000 loss, does actually arise within the penultimate tax year. So what do we want here? Penultimate tax year, 1819. Now we want, there is only one component to this part of the terminal loss. We want the loss from a date 12 months prior to the date of cessation. Date of cessation, 31st of May 19. 12 months prior to that, the 1st of June 18. So we want the loss from the 1st of June 18 through to the end of this penultimate, the 1819 tax year. So that will be the 5th of April 19. From the 1st of June 18 through to the 5th of April 19. Now it doesn't matter which way you work here, whether you work back in time or forward in time. If we were to work back in time, we know that in the final tax year we had 2 of the 10 months of the final period of trading. Therefore, what's going to go in here? The remaining 8/10 of that loss of 20,000, and that therefore will be the remaining £16,000. But what we've also got, of course, is a further 2 months. Look at what we have. The final period of trading was 10 months that ended on the 31st of May 19. We've now dealt with all of those 10 months, 2 months there and 8 months there. That still leaves, of course, a further 2 months that arose within a 12-month period in which there was a profit of. Now let's just go back to, there we go, the year ended 31st of July 18. 2 months of that fall into the last 12 months of trading, so we've got to take account now in this terminal loss calculation of just 2/12 of that £6,000 worth of profit. Well, 2/12 of course is 1/6 of 6,000, that is £1,000. So that reduces down the loss of 16 to a loss of £15,000, which when added to the 9,000 already computed is an overall terminal loss figure of £24,000. £24,000 is the amount of terminal loss relief available to us. What can we do with that terminal loss relief? We, of course, will set that off against the trading profits of the final tax year and then of the 3 penultimate, the preceding 3 tax years, starting with the penultimate tax year and working backwards. Now, of course, what we've not yet done is to identify what those profit figures are. And you can do a working here that is very similar indeed to the working that we did when dealing with opening years. And that means we're going to look at all of the tax years concerned and then carry the loss back as far as we are able. Now, let's have a little look at the information of the question and what they've given to us. What we know here is that we ceased trading on the 31st of May 19. That meant that 1920 was the final tax year, so 1819 was the penultimate. We've already identified that information here within the very specific terminal loss computation. But so far as assessments are concerned, 31st of May 19, 1920 was the final tax year, 1819 was the penultimate. Assess using CYB for that year, and the year ended 31st of July 18, ends in the 1819 tax year. So using CYB, the £6,000 would be assessed. What that means is that the £20,000 plus the overlap profits, those would be allocated to the final tax year in working out, as we did in our Donald example, the actual loss that arose for that final year and the amounts that would be available to be used if we so chose against total income of current and or preceding tax year, and after either of those claims, the extension claim against capital gains. That's not needed here. All they want is the terminal loss. So we've got 1819, £6,000. Therefore, the year ended July 17. That ends in the 17-18 tax year, and therefore using CYB will assess 28,000. Now you can see that we only have a loss of £24,000. So, although they've only given us the ability to compute assessments for the 2 years prior to the final tax year, 18-19 and then 17-18, there are enough profits within those 2 years to fully absorb the amount of terminal loss. We could, of course, have gone back as far as the 16-17 tax year. So what would we be doing? Again, we can do a narrative answer to that, as you will see indeed in the answers to this example in the back of the notes. Or we could have identified, well, 1920 was the final tax year, 1819 preceded it, 1718 before that. Ostensibly, we could have gone back as far as 1617, because when we include our trading income, we know it's a nil assessment for 1920, £6,000 for 1819, and what did we have? Let's look back, sorry about that, 28,000 assessed in 1718. Now, if needs be, if the loss had been bigger, that had given us the figure for the year ended the 31st of, July, we'd have had the year ended 31st of July 16, because that would have been assessed in the 16-17 tax year. So we'd have included that as well, but not needed here. Our terminal loss relief to apply. Was there anything to deduct it from in the final tax year? No, there wasn't. So then, on a LIFO basis, back against the preceding 3 tax years, so LIFO, so against the £6,000 first of all, eliminating all of that. That uses 6,000 of the available £24,000 of terminal loss. That leaves us therefore with £18,000 remaining. That 18,000 would therefore be set against the 28, and that would still leave £10,000 still assessable for the 17-18 tax year. Again, when dealing with a number of tax years over which loss reliefs may apply, as we've seen all the way through in Chapter 7, in point of fact, we produce the information on a columnar basis. Remember, this loss relief, terminal loss relief, only goes against trading income, so we've identified the loss directly against that. If you had to go on and establish tax liabilities for any of the tax years, then down here you'd list any other income, get your total income, get your net income, take out your personal allowance, get your taxable income like you would on any income tax computation, and then proceed to tax, though that is an unlikely requirement, I have to say. Okay, check through therefore with the suggested answer at the back. Make sure that you are happy with this. Practice these techniques again well before you move to your revision phase, and most especially before you walk into the examination room there. But again, be very careful on a losses situation on cessation of trading. Do make sure you read that question's requirement. You only need to answer the question that they've asked. Here, I've not attempted to work out the actual loss for the final tax year. I've not bothered with assessments other than needing to know what the terminal loss was going to go against. Again, what a typical Section A question might ask you to do is not show how it's applied, but do that. Calculate the terminal loss relief available. Here we've done it, 24,000 split into those two parts, the part of the last 12 months of trading that fell in the final tax year and the remaining part of the last 12 months of trading that fell in the penultimate tax year. That thankfully finishes off our various loss reliefs for the unincorporated trader. We'll meet loss reliefs again for trading, but there it will be incorporation tax when a company sustains a loss. They have different rules to what we see here, though again there'll be a similarity in terms of if a business makes a loss, then it will be a company. Then you can either use the loss in the same period, like we've used in the current tax year. You can go backwards in time, you can go forwards in time. So it's the same basic logic, it's just that we need to then apply the very specific rules of corporate tax. But that awaits us in a much later chapter.